There is no precise science to trading, whether you're dealing with century-old stocks or newborn cryptocurrencies. Or, if there is, Wall Street's top players make certain that the formula stays a well-guarded secret. Instead, we have a plethora of instruments and procedures used by traders and investors. These methodologies may be divided into two categories: fundamental analysis, FA, and technical analysis, TA. In this two-part video series, we'll go through the fundamentals of fundamental analysis. What exactly is fundamental analysis? Investors and traders employ fundamental analysis to try to determine the intrinsic value of assets or companies. To appropriately value these, they will conduct a thorough examination of internal and external variables to decide if the asset or firm in issue is overvalued or undervalued. Their findings may then be used to better create a strategy that is more likely to generate positive results. For example, if you were interested in a firm, you could first investigate its earnings, balance sheets, financial statements, and cash flow to obtain a sense of its financial health. You may then zoom out of the firm to examine the market or industry in which it operates. Who are the opponents? What demographics does the organization want to target? Is it broadening its scope? You may zoom out even further to examine economic variables such as interest rates and inflation, to mention a few. The above is an example of a bottom-up approach. You begin with a business of interest and work your way up to understand its role in the larger economy. You may also use a top-down strategy, in which you limit your options by first looking at the overall picture. The purpose of this form of analysis is to calculate a predicted share price and compare it to the present price. If the figure is more than the current price, you may assume that it is undervalued. If it's less than the market price, you may believe it's now overvalued. With the information from your analysis, you can make an educated choice on whether to purchase or sell that company's stock. Technical analysis, TA, versus fundamental analysis, FA. Traders and investors who are new to the cryptocurrency, Forex, or stock markets are sometimes perplexed about which method to pursue. Fundamental analysis and technical analysis are diametrically opposed and use very different approaches to study various topics. Nonetheless, both give trading relevant data. So, which is the best? In reality, it may be more appropriate to examine what each offers to the table. Fundamental analysts, in essence, feel that stock price is not always indicative of a company's underlying value, an idea that guides their investing judgments. Technical analysts, on the other hand, feel that previous price action and volume data may help anticipate future price movement. They are unconcerned with researching external causes, preferring to concentrate on price charts, patterns, and market trends. They want to find the best places to enter and depart situations. Proponents of the efficient market hypothesis, EMH, argue that using technical analysis to consistently beat the market is impossible, TA. According to the hypothesis, financial markets reflect all known knowledge about assets, they are rational, and already take into account previous data. Weaker variants of the EMH do not dismiss fundamental analysis, but stronger versions suggest that gaining a competitive advantage is impossible, even with diligent study. Understandably, there is no objectively superior strategy among the two, since each may provide significant insights into distinct areas. Some people are more suited to particular trading strategies than others, and many traders utilize a mix of both to see the larger picture. This is true for both short-term transactions and long-term investments. Popular fundamental analysis indicators. We don't turn to candlesticks, MACD, or RSI for fundamental analysis insights. Instead, we employ a few FA-specific indicators. We'll go through some of the more popular ones in this section. Earnings per share, EPS. Earnings per share is a well-known indicator of a company's profitability, indicating how much profit it produces for each outstanding share. The following formula is used to compute it. Net income less preferred dividends, number of shares. Assume a corporation does not pay dividends and has a $1 million profit. With 200,000 shares issued, the algorithm yields a $5 EPS. The math isn't extremely difficult, but it may provide us some insight into possible investments. Companies with greater, or increasing, EPS are usually more appealing to investors. Some people prefer diluted earnings per share since it takes into account variables that might increase the total number of shares. Employees, for example, are offered the chance to acquire business stock via stock options. We would anticipate a lower value for diluted EPS over simple EPS since this normally results in a greater number of shares divided by net income. Earnings per share, like other indicators, should not be used as the primary statistic to evaluate a potential investment. Having said that, it's a useful tool when combined with others. P/E, price to earnings ratio. The price to earnings ratio, or simply P/E ratio, evaluates a company by comparing its share price to its earnings per share, EPS. It is computed using the following formula: earnings per share, share price. Let's return to the prior examples corporation, which had an EPS of $5. Assume that each share is worth $10, giving us a P/E ratio of 2. What does this imply? It all depends on what the remainder of our investigation reveals. Many people use the profit to earnings ratio to assess if a stock is overvalued, if the ratio is greater, or undervalued, if the ratio is lower, if the ratio is lower. It's a good idea to consider the figure by comparing it to the P/E ratio of comparable organizations. Again, this rule does not always apply, thus it is best utilized in conjunction with other quantitative and qualitative analysis tools. P/B, price to book ratio. The price to book ratio, also known as the price to equity ratio or the P/B ratio, may tell us how investors value a firm in comparison to its book value. The book value is the value of a company as defined in its financial reports, typically, assets minus liabilities. The formula is as follows: share price, book value per share. Let us return to our earlier instances of our organization. We'll suppose it has a $500,000 book value. Each share is worth $10, and there are 200,000 of them available. As a result, our book value per share is $500,000 divided by 200,000, which is $2.50. When we plug the figures into the calculation, we get a price to book ratio of 4. On the surface, this does not seem to be a positive situation. It indicates that shares are presently trading for 4 times what the firm is truly worth on paper. It might imply that the market is overvaluing the company, perhaps due to unrealistic growth expectations. If we had a ratio smaller than 1, it would indicate that the value is worth more than the market now recognizes. The price-to-book ratio has the disadvantage of being better suited to evaluating asset-heavy enterprises. After all, businesses with little tangible assets are underrepresented. Thank you for watching and don't forget to watch Part 2.